Hello, listeners. Welcome to another episode of the Jacob Shapiro podcast. As usual, I'm your host. I'm Jacob Shapiro. I'm the head of geopolitical and macro research at the Bespoke Group and also a partner at Cognitive Investments. We will be talking more about what all of that change in my title means in future episodes, but now is not the time. Really excited to welcome PauloMacro onto the podcast. That is, of course, his alias, and we will have a link to his Substack in the show notes if you'd like to talk to him more. For some folks, I'm sure he will come without introduction or will not need any introduction. But he's basically one of my favorite follows on financial Twitter and on financial Twitter. Should it be financial X and global macro in general? And I got a chance to meet him a couple months ago at an event where we were both at in New York City. And we said we were going to follow up and do a podcast, and we finally got to it. So thank you, Paulo, for making the time. I think he's agreed to come on at least more times in the future, so that'll be great. Listeners, if you want to talk about anything else that we do, any of the services we offer, my thoughts on what you had for breakfast this morning, you can email me at jacob@cognitive.investments. Otherwise, I hope you're all doing well. Take care of the people that you love. Cheers, and see you out there. The genesis of our podcast was I don't even remember when we met each other in New York City. Was that even 2 months ago? Time has no meaning for me. I hope you're doing well.
I'm doing pretty well. Yeah, it's been a bit of a blur. This summer feels like it went by really fast, and yet the days are really long too.
Yeah, and so it's still summer down here in New Orleans. I don't. It's probably a little bit cooler up where you are.
Oh, I meant to ask you, how did everything work out with Francine and the whole hurricane?
Francine was a wimp. I wish all hurricanes were so nice. It was the classic thing where I was so prepared for this one. I had all my devices charged, and I had food for days, and I had instant coffee in case everything went down. And of course, we never lost power, which is extraordinary. For Ida, we lost power in my neighborhood for like 10 days.
Wow.
Flickered once, and no real damage. It took me about 3 hours to clean up the yard afterwards. So if all hurricanes are like that, I'll take it.
Wow, lucky break. That's great.
But I said this on my Substack, though, that there was one lesson in this for me, and I'll just say it here in the podcast because it actually relates to some of what we're talking about. The National Hurricane Service, from the beginning, was predicting the track of Francine would be much further west than it was. So when they were first reporting the tropical disturbance, even before it had even become a storm, I really wasn't that worried because I didn't think New Orleans was going to be in the path. I thought, if anything, we were going to be on the very fringe of the path. And slowly but surely, the storm kept sort of going east and east and east. And the interesting thing was the National Hurricane Center never really updated its models. They kept on insisting, no, this is going to go further west. It's not going to go this way. But if you turned on local news here in Louisiana, you had all these local weather forecasters saying, well, the National Hurricane Center is not integrating some of these more tropical models into their overall model. And our tropical models are telling us that this is coming east and that we might really be in the crosshairs of this thing. And as it turned out, those local Louisiana folks on the local news stations, they were way more correct than the National Hurricane Center. So I think there's a lesson in there for markets and for political analysis and everything in general.
Yeah, that's interesting. Sometimes you just have to look out the window. You know what I mean? We get so caught up.
Well, so Paulo, let's start right there. Looking out your window, how does the market look to you today?
Man, I was really concerned about a soft patch back in late April, early May. Started talking about it and writing about it, and then in August, oddly enough, after we'd sort of had that yen, dollar yen touching off problems with momentum trades and kind of a general de-risking, the data started to actually show signs of strength, the coincident kind of U.S. economic data. And while economic surprise indices and such are still sort of bumbling along the bottom, they've stopped declining. And generally speaking, the sort of real economy, when you look out the window, seems okay. That's not to suggest that there isn't a trapdoor right around the corner, but it seems to me that we're just sort of bumbling along, and the market kind of has been schizophrenic over the last sort of 2 to 3 months and running away in one direction or the other. And I have a chat actually with a few friends that we recently renamed Sideways is not an option, because it seems like either it's when moon or shit, we're crashing. And everybody forgets that, like, maybe sometimes we just kind of bumble along and things are okay. That said, there are still risks. Um, some sort of longer leading indicators are showing signs of softening. But the coincident data still comes in okay. And so the question becomes like, do we get some sort of, I think ultimately it all comes down to employment, right? Which, as we know, is mostly a lagging indicator with some sort of a few kind of smatterings of coincident indicators like warn notices when a company is about to do layoffs. That's pretty tightly coincidental to what's going on in the economy at large. By the time you see the employment prints, it's lagging.
Mm-hmm.
And the weakness that we saw in the employment prints back in July, for instance, and then the big hullabaloo of the revisions downward from the QCW data, the census data, was sort of like a look back to the soft patch that started to turn up in the coincident data and some of the kind of short edge leading data back in the late spring. And this bounce now, this is very short termist, but my point to suggest that we have seen a little bit of strengthening in the data, ironically enough, just at a time when the Fed is looking to cut. And I think one plausible scenario, and I know that there are a lot of people on the other side of this view, and there's some people who are very vocal that the Fed, even at 50, is behind the curve, and they're seeing a collapse around the corner in employment. And a lot of that tends to go back to a job loss begets a job loss begets a job loss type of logic that's embedded in the Somme rule type controversies that have been going around of late.
Mm-hmm.
And with respect to that viewpoint, which is certainly a fair one, I think that there is kind of a stasis and an odd equilibrium in the job market as it relates to the financial markets, because no CEO wants to commit the same mistake, fire a bunch of people, kind of jump at shadows here, have the economy sort of push through and bumble along, and then have to go out and hire bodies that they might not be able to find and recommit and relive the same thing that happened in 2020 and 21, where suddenly you had to hire a bunch of people back and you had to pay them up 30% just to get them to show up. And I think those scars are still in a lot of corporate leaders' minds. And I think that the only thing that really pushes them over the edge to preserve margin is a huge correction in the financial markets. And as long as corporate credit remains pretty well behaved here, it's showing signs of twitching. But I mean, these sort of flows come and go. The issuance has been just enormous in the space. So you could ascribe some of the moves recently to that. But I have to fight an innate bearish tendency. Like that's my sort of avatar as a cloud bear. My baseline is the world's going to end. And I have to fight that. So like, take this for what it's worth. I think it says a lot when somebody like me is saying like, yeah, things are okay. And I don't know what opens the trapdoor necessarily right in front of us, but I do actually think that there's a window here where an aggressive Fed we're recording this on Tuesday, the 17th, right? So the Fed is tomorrow. And this will all sound completely stupid in 24 or 48 hours, I'm sure. But an aggressive Fed that does 50, for instance, the way the press has been kind of pushing it over the last few days, I think could actually sort of sprinkle a little bit of gasoline on a fire here. We'll have to see what the market reactions are across assets. The bonds certainly seem to be pricing in 50 and the prospect of a recession. It's an interesting thing what's going on in the bond market that we can get to later. I know it's a little technical and maybe a little boring to listeners who are more bent on politics, but with the Fed sort of throwing a bit of gasoline on the fire, assuming they do a 50 and then guide for more, and their projections, the quarterly SEP projections that come with the decision tomorrow, if it shows, let's say, 125 between now and the end of the year, which I think is aggressive, it'll probably be like 100. Then you're talking about a 50, and a 25, right? Because there are only 3 meetings, including tomorrow's. 100 would suggest a 25, a 50, and a 25, or a 50, 25, 25. So like, we're kind of in a weird window where, forward guidance and their projections and what they say they think they're going to do in the very near term, they don't have a lot of time, and you've got the election in the way as well. So it's a fascinating setup where they may actually just do the 50. the market wants the 50. The press wants the 50. A lot of people want the 50, and that could actually touch off some pretty interesting positioning changes. The market is very long defensives at the moment. Utilities positioning, for example, which is kind of a long bond proxy, is back to levels of allocation that we haven't seen since '08. Commodity allocations are this is per the Bank of America Fund Manager Survey that just came out this morning. Commodity allocations are back to 7-year lows. We haven't seen allocations this low since 2017. I mean, that's pretty wild when you think that people are really underweight cyclicals like energy, materials, and consumer discretionary. And they're really long defensives like utilities and consumer staples. And something as simple as the Fed initiating a cutting cycle pretty aggressively could touch off some, I don't want to say risk on, because ironically, the index now is so top heavy between Mag 6, I'll leave Tesla out of it, the sort of big 6 tech companies that are sort of seen as safe havens and parking spots for big money. And the smaller kind of cyclical names are so small on a weighting basis now versus where they were 2 or 3 years ago that you could see a tape that kind of goes nowhere, but a very violent rotation. And people like me will call for this from time to time. And I do think that this has potential in the next month or two, especially with the uncertainty around the election, where people are mispositioned for a cyclical bounce that is already underway, and that since August, and that the Fed could be throwing gasoline on a little bit on the fire for. I'm not saying like inflation will rip from here and we'll be back at 9% CPI in 6 months, but there are reasons to think that we could sort of cycle higher in both growth and inflation, and that's not a great environment for bonds and for bond proxies and defensives. And it's not necessarily a consensus view either, just based on the positioning data. So that's a long-winded way of saying I think that like the Fed and other events between now and the election could touch things off. It won't look like much necessarily at the index level, but it could involve a lot of opportunities for rotation and reallocation. And quarter end is right around the corner in 2 weeks as well, and pension funds will have rebalancings to do. So I think things will be interesting in the coming weeks.
Yeah, always. And I mean, is the opposite of a cloud bear a cloud bull? Because we're a good match. Because my innate tendency is to think that things are going to be good, and your innate tendency is that things are going to be bad. So we might actually sharpen each other's views here a little bit.
Between us, we can rule the world.
But between us, we can get a happy medium and just be wrong in both directions.
Exactly.
But so I wanted to, because I'm stuck on this point about the real economy, and I want to ask you exactly what the trapdoor looks like that you alluded to, because I also look out at the real economy, and I seem to see that things are mostly good, and it's hard to sort of square that with the Fed is being pushed for 50 bips of cuts, because if things are good. And if inflation is still a problem, and I do think inflation is a problem, and I think that the Fed has. This is not anything new, but the Fed thinks that with interest rates, it controls everything. And I have been saying for years now that I think some of what is driving inflation, not all of it, is on the supply side. That even if commodities themselves are down, like who's processing the commodities? What are the input costs for some of these different things? When you start actually breaking it apart, like prices are still relatively elevated. And if, as you say, you pour gasoline on a fire, you could easily go back to sort of where we were just recently. So help me with what I'm missing here. And I also just want to underscore what you said, because most of the time I don't like short-termism or even thinking on these types of time horizons. But I think what we're talking about could actually massively impact the election. If you get 50 bips of cuts and then more cuts coming, and people are starting to feel better, and the data continues, as you say, in this little uptrend, that's really, really good for Kamala Harris. That's really, really bad for Donald Trump. So, like, what happens here over the next 6 to 8 weeks, even if it's a false start, is going to have massive implications on what happens in November.
Yeah, I agree. And actually, I would say 3 things. It's kind of the best of all worlds for Kamala from the perspective of the financial markets, assuming that Kamala is seen as sort of a Biden heir apparent, certainly an incumbent type candidate, even if it's not Biden running again, because you have oil having completely crashed out, right? With this move down by 15, $20 just in the last sort of 6 weeks. And crack spreads to, gasoline and diesel products, because we don't put oil in the tank, obviously, have also collapsed in tandem, which means that gasoline has sort of taken a double whammy of a declining oil price and a declining manufacturer spread or crack spread refining spread. So gasoline futures are below $2. And there's usually about a 1 month lag between what the oil price and refined products do in the futures market versus the pump. And so if you think that we just bottomed in oil last week in the kind of, like 69, 70 area for Brent and a little lower for WTI, even if, the oil price were to start to bounce here, and it looks like it's showing signs of that. Positioning has been just more extreme than anything I've ever seen in that market on the bearish downside. You're still looking at a gasoline price at the pump that's going to be falling over the next 3 to 4 weeks, and in a lot of places, it's funny. My father-in-law, he rarely comments on stuff like this, but he actually made the comment 2 weeks ago, like, have you noticed how cheap the gasoline price is at the pump? And that registered with me because, like, that's something that people notice, right? And we're knocking on $3 a gallon, and maybe looking at a two handle in the Northeast, at least where I live. And so that's great, right, for the incumbent. The market's knocking on all-time highs is great, because people open their 401k statements that come out after September 30th, and they've never been wealthier, right? Because a lot of them might be in target date funds that are a blend of stocks and bonds have also rallied, which has also taken a lot of pressure off of financial conditions and helped people's target date funds out because they own some bonds, and also solved Yellen's problem of issuing a ton of debt at lower rates. So suddenly people aren't talking about fiscal problems and fiscal dominance anymore. Like you start to talk about a crisis like that, and people will look at you and be like, well, where's the 10-year? And you say, oh, 380, 370. And they'll say, so what's the problem? Like, hasn't it always traded there? It's like tick tock, tick tock. But bonds, stocks, and oil being where it is literally the trifecta for an incumbent to win an election. That said, Trump has been shot at twice. There's a sympathy vote to that, I'm sure. And I mean, in Brazil, when Bolsonaro got stabbed on TV and almost died, he got a huge surge, certainly in the quiet vote, but he still won. So there's a lot of give and pull in this election. I don't presume to have a strong view on who wins and how this all shapes out afterwards. But from a financial markets perspective, if I were a betting man, I would bet on Kamala. I'm not betting on this election, but I'm just making the observation that she literally couldn't ask for better as an incumbent type candidate, with oil, interest rates, and the equity market where they are today.
Well, and it's her biggest weakness, and it was obvious in the debate too. She did very well in the debate, but the first 5 to 10 minutes of the debate, she really stumbled through her answer on the economy. And Trump has huge unfavorable ratings, even among the people who were for him. Like, there are a lot of unfavorable ratings about different parts of his personality or what he's done. But where he is strongest is that he is seen as the better steward of the economy. Why that is, we'll have to get a psychoanalyst on here, because for the life of me, I guess people just didn't grow up around, New York real estate moguls. It doesn't, the charm does not work on me, but that's what people think. People think that he is good for the economy. And if Kamala can chip away with that, with, as you say, a triumvirate of great economic outcomes, that's going to be really, really positive for her. I'm glad you brought up oil, because I want to sort of dive in there a little bit, because I know I will at least speak for myself. I've been a little bit flummoxed by oil's behavior this year so far. I sort of had really good years in 2021 and 2022, especially as the world was freaking out around the Russia-Ukraine war and just not doing a good job of counting barrels and counting supply on both sides. But I have been surprised at how far oil has already gone down. And even good news for oil prices doesn't seem to do anything to the price. If anything, it goes down. I know you say that it looks like maybe we're coming back up, but Libya has had tremendous problems in the last couple of weeks, and we've had a lot of Libyan production offline, and yet oil was continuing to go down. And if there's one thing in the real economy that gives me some pause that things are okay, it's, as you say, oil continues to decline. So help situate with me with where you're thinking about oil right this moment.
Sure. We can talk about the physical market for a minute or two and then move over to what's happened in the financial market as it relates to oil and its trading. On the physical side, you mentioned Libya. Last week, they just started to come back with what looks like another 100,000 barrels of incremental, but they're still well below the 1,000,000 barrels a day that they could be exporting. They're currently right around 350, 400. Every little bit matters in a market that's drawing. I think the bigger issues are that players like Russia and Kazakhstan are complying, and Iraq is now falling a bit. So there's a narrative in the market. The bear case got very, very loud recently. The key point was look at crack spreads. You really can't rally oil if the price of the end product is falling, because refiners just won't pay up for oil if, as a manufacturer, their end product is declining. And fair enough, cracks lead everything. You want healthy cracks. For context, again, staying with the physical market for a moment, we saw refiners sort of not left for dead, but just bumbling along with their business for many years pre-COVID, earning $15-$20 a barrel equivalent cracks, margins above the price of what they pay for oil. So if a crack spread is 15, let's call it $20. That was actually a really nice price for a lot of these guys. They ran their businesses. Nobody cared about the equities. There was a kind of a slow burning fuse to these businesses in the way they return capital to shareholders. The whole energy complex went through a transformation in the last 10 years where, or especially in the last few years, where they decided to stop lighting money on fire and trying to be more rational because their shareholders started to insist on it. And refiners went through something similar in the 2010s, and nobody really cared. There was also a profound lack of investment. You see in extremis things like in California, where Chevron finally threw up its hands. Chevron for years was a San Francisco-based company, or nearby there, and they finally decided to move to Houston a month ago because you just can't invest in California as an energy company anymore. And the issue then with post Russia's invasion in 22 was that Russia was also a big exporter of diesel and refined products to Europe. And supply chains had to be rejiggered as Russia was taken out of the supply chain by the end of 22. And in the meantime, they were dumping everything that they could in order to get dollars to fund the war effort. And cracks went to the moon. On some days you were seeing $60 cracks, which means the oil price is at 80 or $100, and the equivalent gasoline price is 160, right? These guys had never earned this kind of money in the refining space before. And I think there's been a little bit of people getting used to something as like a new normal. And now cracks recently collapsed from, where they've been sort of chopping wood in the mid 20s to $30 range, which are incredible cracks for guys who were in this business 10 years ago, down to something in the mid teens, $14, $15. And I sit here and I say, look, in relation to 2 years ago, yeah, it sucks. But, refiners did just fine at these levels. I mean, they did okay for a long time. So there's kind of an element of normalization here. But in the meantime, the move down and this kind of normalization really flushed the crude oil input market in financial futures. People see the weakness, and they think that the weakness in gasoline and diesel prices is suggestive of a demand problem. And again, going back to growth and looking out the window, I don't really see the demand problem. Inventories are, flat to down on averages for gasoline and diesel. Jet fuel is building, but these things kind of come and go. So I just don't see the panic. But in the meantime, people really ran away with this, and there was an enormous flush. Shifting for a moment from the physical, the last thing I would say about the physical is that the barrel counters have been noting a discernible draw, sort of like a hiss in the universe over the last sort of 9 months, with a brief exception in the spring, of global crude oil inventory, such that we're now at multi-year lows for this time of year, because there's an element of seasonality to overall crude inventories the world over. And at some point, inventories matter. At certain moments, inventories are all that matter, when people really panic for them. But you've had this oddity where we're drawing, where the financial markets are in backwardation, which means that near dated prices are higher than longer dated prices. So the curve looks kind of like the left side of a U, and or the opposite of a regular interest rate curve. And a backwardated curve where near dated prices are higher, the curve, there's this misconception by people who don't trade futures that the curve predicts future prices, and that's not correct. The curve for at least commodity futures reflects several variables as it relates to supply and demand conditions in the present. So if the curve starts to steepen and near dated prices rise, so the oil price in the screen is going up, but like the price 6 months out is not, that steepening where people are paying up more for it today is also punishing the guy who would normally do a carry trade and store the oil, right? If it's in the hole, for example, taken in extremis, where oil crashed during COVID and you're buying it, technically negative, but there was an issue there with storage and cushioning. But let's say Brent oil was trading in the 20s. The near dated price, or the front month price, is trading at 25, and the second month is trading at 30, let's say. As long as you have a storage tank available, you buy today at 25, take delivery, lock in the future price next month at 30. You're collecting $5 minus the cost of storage, freight, insurance, the financing cost of the position, et cetera. So contango is a way to reward storage and basically tell the market to stop producing. And the more the curve steepens down, where prices collapse in the front, as that contango gets steeper, it's telling you that you're running out of storage, right? Because the cost of storage is going up. So these are kind of ways that I think about it. Backwardation is the opposite. It's punishing the storer. And we've been backwardated all year, despite the bearish case getting very, very loud and the flat price and the screen price that everybody sees collapsing. These curves have remained sticky backwardated. In fact, the time spreads today are the same that they were a couple of months ago when Brent was in the mid 80s. And here we are at $70. And so you sit here and you say, well, the curve is telling you that supply demand is still tight, right? Despite the fact that cracks have fallen. Balances are tight. Inventories are drawing based on what the barrel counters are seeing. And these guys use satellite data because the ceilings of tanks that you see, the big oil tanks at refineries and stuff, the ceilings move up and down. They float. So depending on where the ceiling is in the tank, you know how much oil is in that tank. So it's unless your tanks are underground, and a lot of China's strategic petroleum reserve is actually underground. So it makes it difficult to know exactly how much they have. But if you have a satellite, you just take pictures of tanks and you know more or less like what how much oil there is out there. And you try to infer certain things. It's not precise, but it gets you within a margin of error. We're drawing. And yet the price is collapsing. And all you hear is China, falling out of bed 4 years in a row of Japanification, and the balance sheet recession is back. And, the U.S. demand, like recession is right around the corner. Look at the bond market. It's screaming at you that recession is here. And the oil market in futures is telling you, we agree with that, right? Like we are at the tip of the spear saying growth is falling out of bed in the second largest economy and is at risk here in the U.S. in the largest economy. And yet the market in oil is not telling you that, and the curve is not telling you that, and the premiums paid for immediate delivery are not telling you that. So like we're living in a moment of divergence between what the physical market has today versus what the financial market for oil is saying they think will happen in the coming months. And so my question is, these divergences, they come and go. I've never seen it this big. I've been trading commodity futures for over 20 years now. And I know that that's not a real long career, but I can tell you I've never seen a divergence in the same commodity between the financial markets for that commodity and the physical market for that commodity to this extent. I find it fascinating that everybody, they're quiet bulls out there, and there's a handful of people like me who are very vocal bulls. But when you go to a conference like the APPC in Singapore last week, headlines of what Vitol and Trafigura and these big traders are telling you is that it's depressing, right? These guys, like, nobody's constructive on the oil market, but it's just because the prices collapsed. The mechanics of the market itself strike me as very bullish, in the sense that if I'm going to take a really big position, and I'm now currently extremely long energy, especially oil, and I've been building this position up over the last, call it 2 months, I like to know that a lot of people are going to be wrong. And when positioning in the financial markets is this rinsed out, like, just to give you an example, this past week, and this made some headlines, the managed money category of Brent crude oil futures went net negative for the first time in the history of the commitment of traders reports, i.e., hedge funds and speculators, the managed money category in Brent, are now net short for the first time ever. If you track the data back to the financial crisis in 2008, post Lehman, we did get net short, but the commitment of traders for Brent didn't exist then. The history only goes back a little over 10 years. So, we're at 10-year lows in terms of bearish positioning in the futures market for oil. So I ask guys who are short this market, or who are at least not involved, like, if you're bearish, for you to get paid, you need Lehman to happen. Like, that's where we are in terms of, like, that's what's priced in, is anything short of Lehman. You know what I mean? Like, so you're counting on a financial crisis to lop the head off of the near dated contracts and throw this thing in the steep contango. And then, yes, everybody proved right. Like, the bears were right. They got their crisis. But, like, what if you're wrong, right? I look out the window, like, what if the Fed cuts, let's say an alternate universe, and the economy kind of stumbles through? We continue to sort of cycle 1% real flat, like there's no recession, and you just take that kind of left tail off the table. Well, that's not what's priced into oil right now. You know what I mean? So it's sort of like, what's your risk reward? And I tend to think that, like, the bear case is very, very visible out of nowhere. It's not perfect. It's not like I'm the lone bull out there by any means. There are people who are bullish because they see the data that I do. And that's also not to suggest that, oil rips to 100 from here. I think that there's a chance of that if the right things line up. But, you could just end up with a $5 to $10 bounce, and then we go nowhere, and position just sort of stays where it is, and nobody makes money. The bulls and bears don't get paid. I think in scenarios, but I tend to think that the bear case could run into trouble in the near term, and we'll see what happens.
You mentioned the United States scenario. Where does China fit in? Because, like you, my career hasn't been super long so far, but I'm getting to the point where if I had a nickel every time I heard some of these experts out there predicting the collapse of the Chinese economic model, I would start to be quite wealthy now. So where does China's demand for oil fit into the picture here?
So the preface is, I haven't been to China in years. Shame on me. Certainly not since COVID, and I've missed a lot in the last 4 years, admittedly. People who've been going recently tell me it's night and day versus where it was 5 years ago, even, which is astonishing. There's a lot of narrative, and then there's a reality on the ground. I tend to defer to some friends of mine who I keep close for their knowledge and their expertise exactly in this area, because China for me always scares me in terms of the black box, and me being the foreigner and the ugly American who doesn't really know what's going on over there. And so I won't wax from a distance like I know what's really going on. But I will say, China is still using 4 barrels a year per capita. It's a level, just for comparison, that is woefully below developed market standards. When you go to Shanghai, Beijing, major cities, even second-tier cities in the interior, you'd think you were in a developed country, right? But the country as a whole still underconsumes oil, and that 4 barrels per capita context, the U.S. is at 20, Korea's at 20, Thailand is at 7, right? Because Thailand doesn't produce their own oil like China. They're a net importer. So they have this kind of geopolitical vulnerability and strategic vulnerability. But for the Chinese to just go from being China to being Thailand and go from 4 to 7, they'd have to go from importing 13 million barrels a day today to 23 million barrels, like a 10 million barrel swing just to get to Thailand at 7. Never mind to converge with the West. And then you can always, debate, will, China get old before they get rich? Like you said at the top, like the truth is probably somewhere in the middle. But man, like even just taking 4 from, 4 to 5, that's another 3 million barrels a day. Like that's a real number for a market that has, again, going back to the bear case, besides gasoline, diesel, refined crack spreads, the other big bear case has been excess capacity by OPEC. Now, OPEC has always had excess capacity. In the 80s, OPEC had something like 15, 20 million barrels a day of excess capacity. 10 years ago, they had a couple of million barrels a day. But for whatever reason, people are really focused on the fact that the Saudis only do 9 million and supposedly they can do 12. I don't think it's anywhere near that number. That UAE wants to do, ramp another 2 million barrels a day. So there's at least 3 to 5 million barrels of spare out there. And it's like, okay, boy, that could go really fast though, because demand structurally is sort of a straight line over the years. We pretty much add 1 million barrels a day of demand. We're currently at 103. You just use 100 million barrels as a round number, but at 103 million barrels a day. So in 3 years, you're at 106. A lot of that could be China, or China could have plateaued here for 10 years. But you have other markets that are even farther behind China. Like, I know that Africa has a capital formation issue, but there are economies in the third world and in underdeveloped markets and frontier markets that are consuming 1 barrel of oil per capita a year. Most of these people don't have a fridge. You know what I mean? So there's a volume story here that I think actually, going back to the Fed, really could be set on fire if the dollar were to weaken, in part because the Fed is taking its interest rate boot off the neck of rest of world growth. A strong dollar is a very powerful headwind for foreign economies in the dollar system today to be able to grow, to invest and grow when they have to compete with a treasury that pays well here in the US. The Fed cutting rates could actually do. It's odd, right? Like the Fed hiked so aggressively, more aggressively than they ever have in terms of the pace in 22 to kind of catch up to their transitory inflation mistake. But it didn't have much of an impact at all on the U.S. economy, but it sure seems to have coincided nicely with like a huge trip down the stairs for China, right? And the rest of the world that's sort of been languishing. Europe, people will point to Putin and energy price, but it seems like every region has an excuse, and people kind of ignore the big truth in plain sight, which is that the dollar has actually been quite firmly bid up and to the right with an interesting path over the last few years, in tandem with an interest rate environment in the U.S. that's been somewhat restrictive and sort of a magnet for foreign money. You relax that, the capacitor of energy that's charged here in the U.S. with higher rates over the last couple of years releases capital back into the world. This plays back into the potential for this Fed to sort of, what's the word I'm looking for, touch off a rotation in many respects, including a rotation from U.S. to rest of world, U.S. to EM. I'm not saying that China rips out of the hole growth-wise or even market-wise, but at the margin, the arrow of capital flow starts to point the other way. And that is very good for commodities. And interesting timing that commodities, as of this morning, according to Merrill, are at 7-year lows in terms of percent allocation by investors, because it's precisely the fact that everybody's out of it that gets, that they're buying gets the price to move up. Waxing philosophical, a trend or a price chart that you see that's up and to the right or down and to the right, I've always just viewed that quite simply as, a trend is just an idea catching fire. So if a stock is trending higher, it's because an idea around that stock is catching fire and spreading like a virus. And the fact that nobody is there, again, I like to be in places where I think that a lot of people are going to be wrong, because as they correct their mistake, I get paid. And I can't help but shake this sense that everything that's happening in the next few months around monetary, fiscal, and election decisions in the U.S. Will have huge implications for the rest of the world that become obvious in hindsight in a few months, and set trends off in the new direction. And part and parcel of this is the consumption number in emerging markets that has so much runway if the dollar were to weaken and if financial conditions were to loosen in the US. Like the bottom line is the Fed hiking 2 years ago didn't do much to slow the US down. So why would interest rate cuts do much to goose the US? But the goosing is going to go somewhere. And if you think about it, it stands to reason that the Fed being restrictive over the last few years really hurt the rest of the world on the margin. I would tend to think that the Fed loosening up a bit here is actually going to help them much more than it helps us. Mm-hmm. And so that's kind of how I bring it all home.
Yeah. Well, let's test you with a commodity, or at least a class of commodities that has not done well at all, which is grains. And we have quite a few agricultural listeners on the podcast as well, or who listen to the podcast. You were talking about being at an energy conference or the doom and gloom at energy conferences. I've been at a couple ag conferences in the last couple months, and I'm actually going to be at one next week. And farmers are as glum as I've experienced them in the last couple of years because of how low prices are and how high the cost of inputs are.
Yeah.
So talk to me a little bit about grains, because the picture you're painting here sounds like maybe there's some relief coming, but judging on your first reaction, maybe it's a little premature.
Yeah, there are some commodities that don't really respond with the complex one-to-one, and grains are sort of the big one for me. They sort of, it's kind of its own caged animal, and in a way, you tend to see things go very right when lots of things in the world are going wrong. The obvious case being what happened with grain prices after the Russian invasion and the immediate aftermath with the spike. Grains has been difficult for me because I got very bullish. It got my attention in the spring around April because positioning was so bearish and so profoundly negative in the futures markets. And there were signs, as I did more work in May, June, that for wheat, for example, specifically, there were going to be drought and weather-related issues in the key crop-growing regions east of, eastern Ukraine, but also east of Ukraine in sort of the heartland of Russian production. And in corn, there were signs that perhaps, the extreme wet that we had early on in the season, and there was record flooding in certain counties in Iowa back in May, June, that was crazy, like, second or most wet year in 130 years type of stuff. And these are extremely short cycle commodities. So kind of the opposite of what you're dealing with in oil and industrial metals, copper, et cetera, where, it may take you 10 to 15 years just to get a mine permitted and built. Grains are a difficult one. Like, you really have to be an expert. And even then, the experts periodically get run over because an imbalance in one season can be corrected the following year pretty, with a little bit of, planting and hard work and weather cooperating. So it really is a year to year type commodity. And therefore, they tend to boil down to weather trades for me. Friends don't let friends gamble on the weather, for starters. But if you are going to gamble on the weather, grains are, tend to be where you're going to do it. It didn't work out. It's weird, especially in wheat for me, because you have a new agricultural minister in Russia that started a couple months ago. And whenever you get somebody new in charge in a place like Russia, you don't, it's the opposite of putting a new CEO into a company that needs a restructuring. The new CEO usually kitchen sinks the first quarterly earnings number, and that kind of wipes the decks for him to, quote unquote, do better. The opposite tends to happen in places like this, where like this guy's not going to come in on month one and alert Putin to a problem. I'm still shocked based on what I saw from satellite data, precipitation data, that the Russian crop is coming in where they claim it's coming in. I'm at a loss. I guess I don't know how to read a map, but it, I think we live in a world where stocks are tighter than they appear, but people will simply not trade that because, again, go harkening back to the physical versus futures issue in oil. The market will not price in what it thinks balances might be when the signals they're getting from official people in charge, whether it's the USDA here. I don't ascribe to the fact, like to the notion that like corn stocks are way lower in the U.S. than the USDA claims, or blah blah blah. I take the data at face value because I have to, like everybody else does. But I have a sneaking suspicion that there, especially in the wheat market, there is less than meets the eye. But I don't know when this actually becomes a problem, if it ever does, for the market to begin to price in. It might be next season's issue, and timing is everything. So a long ramble to say that the grains are not a particular area of happiness for me this year. When I look at this space for the U.S. farmer, again, just as an observer, I am not one, and I don't have anyone in my family who is. So, like, I'm really just talking to buddies. I like the U.S. farmer's in real trouble at these prices. When you start running like simple napkin math on expenses, acreage rent, these guys are losing money at current pricing, especially in corn below $4. We're back above $4 now for new crop, but I mean, the U.S. farmer is going into a depression, and it gets messy because there's a national strategic issue around not bankrupting the farmer, right? In China, the price of corn is twice what it is here in the U.S. They pay around $8 a bushel, but China deliberately keeps the price of corn high because they want to encourage domestic production, because they're already vulnerable in oil. Food is that much more critical to them. Like it is a cost that they're willing to run and manage to keep the corn industry breathing in mainland China. But that also means that we're producing too much corn around the world until we're not, and until the weather screws up something big, and the prices skyrocket, and China just doesn't want to be caught in that position. So it's when these commodities are not working, they're really depressed for a very, very long time because of that. And then when they work, they really, really work. So we're living in a much more volatile world for this sort of commodity, in the grains in general, I mean. And I fear for the U.S. farmer and their sanity, because it's difficult enough to navigate your business as a farmer, to do that with grain markets that are that volatile. Must be an enormous point of stress for them, personally and financially. And this is also why the government will continue to support the U.S. farm sector where it can. I don't know, man. For me, the grains were among the biggest screw ups that I've had in 2024. I really thought that this summer, fall was going to see some fireworks, and it's been much ado about nothing. The only conclusion that I come away with is that, like, the math is the math, and the U.S. farmer is right to be depressed, because like the numbers don't add up to make money in this sector. And if it stays this way, these guys are really going to have a financial problem.
Yeah, I agree with you on some of that. Although I'd push back a little bit and say, at least when we're talking about corn and soybeans, your energy thesis will bring some reprieve, because when you start talking about renewable diesel and ethanol and all of these energy plays that are sprouting up, if energy is going to go higher, that's going to at least save some of the pressure there. And ironically, the way that the U.S. government has most supported farmers in the ag sector has been through energy. I still do not understand, why the Kamala campaign. I think they've done a very good job thus far in a short amount of time. But that whole thing about price controls for food was totally mystifying for me because it completely misses the point, which is exactly what you're talking about. The farmer is under pressure, and putting price controls on the cost of food is not going to help the U.S. farmer there too. If you're an optimist, you also, and I've been wrong about this thus far in regards to Ukraine, but if you're an optimist, you say that Ukraine had a really, really bumper crop before Russia invaded, and that they couldn't get a lot of the crop out during the first invasion year, so that they've been slowly depleting stores, and that they've been using up all the fertilizer that they had on hand, and that this will be the first real growing year where the war is going to exert itself on fertilizer supply, where there's not going to be those stores in Ukraine, and maybe you're going to see some of that affect itself on the global marketplace. But I agree with you that the American farmer has been living in a particular macro environment, and that U.S. government policy is positioned to support that environment for almost a century, and that there are major changes coming to that environment, and that the farmers who are not ahead of those changes, if they're just going to hope that the price of these things goes up, like as you said, that's sort of a grimmer picture, which is actually a great segue into the last thing I wanted to talk about. Which is one of the reasons that the U.S. farmer is under so much pressure, is because Brazil is stealing his or her lunch money.
That's
Brazil's
right.
the low-cost producer for a lot of these things, and now they're talking about tropical wheat varieties.
Mm-hmm.
You are Brazilian. You were just in Brazil. I really enjoyed your Substack piece on Brazil. We'll link to it in the podcast. I'll also tell you, we have been bullish on Brazil, Rob and I mean, for years now. So, I mean, Brazil, Japan, Mexico, Turkey, and maybe Indonesia, depending on what day of the week it is, are sort of these are the countries that we really think could take off if emerging markets start to do well.
Yes.
So I was heartened to hear about your Brazilian bullishness. So why don't we close out on that and give us your out the window view of your recent trip there, and why you think things are looking good in your home country?
Sure. So my trip there was more vacation with family than actual sitting down and meeting, business leaders and market participants. But again, just looking out the window, the temperature seemed fine. It's, Brazil is always that kind of country of it's never the view is never as good as it looks. And, the reality is never as good as it is, at the peak. And it's also never as terrible as you think in the trough. But the market is so high beta, and there's still so much local AUM kind of sloshing around on the decline, of course, which I get into the note as well. But when you walk around, things were humming along just fine. If anything, I saw signs of a boom, in the kind of Wall Street area, Faria Lima of São Paulo. It felt like I was also in the south of Brazil where they had horrible flooding a couple of months ago.
Yeah, it's terrible.
So yeah, things are slow to recover there. So that kind of colored me on the bearish side locally. Like that region is still sort of depressed and needs a lot of investment. Flights, everything are way down. But São Paulo itself, which is really like the heart of the Brazilian economy, away from the grain sector, seemed to be humming along just fine. And I was struck over the last 2 months at how bearish the local investor base had become. And then more recently, the foreigner throwing in the towel. And this is just based purely on flows data, which is readily available from Anbima, the securities regulator, our SEC in Brazil. And excuse me, not our SEC. It's sort of like our FINRA. And the sentiment was so bearish, and yet the market had started already to rally in the last few weeks. And it was doing so very quietly. And then it occurred to me this notion that, Brazil is a very sensitive market. It's high beta. It's leveraged to commodity prices. It's very sensitive to deteriorations in the fiscal when a leftist leader wants to do something crazy. So it's an easy market to sort of put your finger on the pulse of. And the fact that Brazil is rallying while oil prices and the commodity complex in general is collapsing was interesting to me. It wasn't the only market in EM that was kind of trying to claw its way off the mat, but the fact that the Bovespa in local currency terms was making new all-time highs. Like if you had told me that sentiment, based on the sentiment that I was hearing from market participants over the phone and also the handful of people that I spoke with while I was there versus what I was seeing on the ground, I would have said, geez, the market must be at like 80,000. And then here it is at 135 and making new highs. And, local conferences were pretty bearish. And even in dollar terms, the market had seemed to be turning up. And then it occurred to me, the Brazilian market might actually be smelling something ahead of the Fed and the commodity complex and the rest of the world. Like, there are a group of investors here that are telling you that this market is sold out and it's starting to go the other way. And maybe it's the proverbial kind of opposite of the canary in the coal mine, like the first sign or the leading indicator that the rotation from US to rest of world in EM, from large cap to small mid cap, from growth to value, it's all connected. This, from growth to commodities, from defensive to cyclicals, like the list goes on, but it's really all one trade. Maybe Brazil is the tip of that spear. And that's kind of the thesis now, which is Brazil's sclerotic. The unfortunately the fiscal is not a pretty picture. The current administration under Lula is not doing investors many favors. But there are actually, and it's unfortunate because he's a very much a lightning rod and a controversial figure and a despised figure by many, and not always without reason. But Bolsonaro, when it came to the economy, did some truly remarkable positive things through Paulo his economy minister. He basically put treasury, finance, everything under this one guy, and told him, they occasionally had some spats publicly, but he basically gave him free rein. And little things like that I don't think Americans really fully appreciate. In you take the tech bubble that we had here, right? This boom in payments and Stripe and processing and all. If you go down to Brazil 5 years ago versus today, you would not recognize the sort of digital technology that Brazil has put in place. This is now a couple of years old, but the central bank from scratch developed a payments processing system called Pix. It's a QR code, kind of inspired by the Chinese, where your phone links directly to a bank account and you can Venmo somebody money or like Zelle people money instantly from your checking account to theirs without ever going through a bank. So you have no fees, no slippage. The biggest issue actually became that people were getting robbed at night and the mugger would come up to you, ask you for your phone and empty your bank account. So like now they limit you, your transfers to other people to, I think it's 1,000 real. There's some limit in the evenings because anybody who's moving that kind of money after 10 p.m. is probably getting mugged. But you look at these kind of innovations, they digitalized. They took the entire federal government and put it in digital form for everything. So today, I just got my license renewed at the DMV last week. It was okay. It wasn't as horrible an experience as I thought. You take a number and you have a reservation, you go see one person at one window with a bunch of paperwork and docs and whatever. In Brazil, you want to renew your auto registration. There's a master app for that, sort of like what WeChat is in China. And you open the app, the pop-up is right there, register your car, couple of taps, you're done. You don't even have to go in. Like, none of this existed in Brazil 5 years ago, and they have leapfrogged the US in terms of the government and the ability to interface with the government in an electronic way. It is shocking when my Brazilian friends come to New York and they open their apps on their smartphones, how behind the US is versus Brazil when it comes to the federal government having moved from a backwater of paperwork and inefficiency to being actually something that is, if not a joy, at least easy to interface with. These sorts of investments that people don't realize were made just in the last few years are paying enormous dividends today. As much as Lula is screwing stuff up, Brazil is actually riding a wave that nobody will admit was sown during the last guy, because that guy was such an ass in so many ways and turned certain segments of the population off. But at least when it comes to the economy, and I'm not saying I agree or disagree, I'm just telling you, like, this is the impression. Like people like will simply not give this guy credit, and that the smartest thing that he did, in my opinion, was putting Paulo Guedes in that seat and giving the guy free rein to just turn the government inside out and get the fiscal of the government on track. And those sorts, Brazil doesn't grow because Brazil doesn't invest. But Brazil actually made a few investments a couple of years ago that are helping it to grow a little bit more than it otherwise would have. And I don't think people fully appreciate that. And that, in the context of everything we discussed with the Fed, potential for rotation, violent or no, commodities kind of, catching a bit again, maybe an inflection point here, there. If the grains prices were to join energy, and going back to that point, I agree with everything you said about the grains at the end. And I would just add that because commodities are not currently an investable asset class, if they were to start to work and attract money, whether it's passive allocation to commodities, that was a thing back in the 2000s where a pension fund would just say, give me 2% in commodities and roll futures. That will help inflate the complex. Certainly grains will be a part of that. There's a way for this stuff to kind of get off the mat, whether energy works, whether inflows work to the space in general. But we'll see. But rising grain prices certainly help Brazil, and rallying commodity prices will help, and these past investments will help. So the Lula administration really has to do some screwed up stuff here to kind of derail a process. Like, unemployment is near the lows. These guys are actually showing signs of overheating, and the central bank is having to move rates higher. They're like 150 bips of hikes priced into the curve between now and I think March. I have to check the exact outlook, but Brazil is actually showing signs of not only growing but potentially running up against a wall, because Brazil hasn't invested much over the last 20 years, besides a few pockets of in the interior grains and Petrobras trying to drill for oil. But like, Brazil doesn't invest, so Brazil doesn't grow. So our potential growth rate is not a Chinese or an Indian high single digit growth rate. If we start to grow 3.5-4% real, we run into inflation very quickly. And there's signs that Brazil might actually be approaching that sort of threshold again, which, when you look at what the equity market has been doing, is kind of telling you that. And yet it's amazing that people are bearish, so I like Brazil. And, the irony is, I'm born in New York, of Brazilian parents. I have a lot of family there, but Brazilians are sunny people. Brazilians born outside of Brazil and who never really lived there tend to be very negative people on Brazil. Like, I look at Brazil and I just see a basket case that ends in the Keynesian endpoint of like blowing up in some giant default. Of course, their default will be inflation. It won't be the default of the 80s. But like, that's, again, I'm kind of a cynical bear at heart. So the fact that I'm saying I'm long Brazil and I like Brazil here, like, I'm kind of choking on these words, but I like Brazil. Like, I think the setup is interesting as we look at 25 and 26.
What for an individual investor, there's EWZ is the ETF, but I've always been turned off by that because such a large component of it is Vale, and that's really not a Brazil bet at a certain level. Now we're talking iron ore in China. So if you were talking to sort of an individual U.S. investor who was interested in Brazil, what would you recommend they take a look at if they wanted exposure there?
Boy, I'm always hesitant to name names because, a month from now, name is down 30%, you look like a moron, or it's up 30% and nobody remembers or cares anyway. And I also don't want to be seen as giving financial advice. So, like, with that disclaimer, everybody should really do their own work, get to know companies if they're looking at specific ideas. Unfortunately, the opportunity set for, Brazil has a non-deliverable forward. It's difficult to send money to Brazil and buy local equities there. You won't find this on interactive brokers. It's kind of a closed off market unless they're ADRs, right? And or an ETF like an EWZ, like you said, that has its own kind of weighting issues. There are some names listed here that came during the boom of like kind of 2019 to 21, either side of COVID, where we had a huge onslaught of issuance and a lot of guys wanted to capture the multiple that US markets were getting at the time, especially in tech. So there are kind of bombed out payments names like Stone Pagamentos, PagSeguro, There are, I don't have my list of ADRs in front of me, but I can tell you that there are some small cap consumer names. It, I, it, I hesitate to say Petrobras because you have the element of the sovereign, and you have the element of the oil price going up helps it, but the oil price going up a lot doesn't help it because the threat of price controls comes back, and that's something that Lula's, um, the president who followed him, Dilma Rousseff, instituted in terms of controlling refinery gate prices. So they didn't. They basically instituted price controls where the gasoline and diesel prices at the pump were fixed to keep the truckers happy, and Petrobras ended up losing a lot of money. And this was when oil was $100 plus a barrel, like 10 years ago. So I, it's cheap, but it's cheap for a reason, and it's the stain of the sovereign that never fully comes out. But even at these levels, I'm getting interested in it. I think it's cheap enough. There are, Volley is difficult because the supply side looks okay in terms of rationality. The demand side, I think, with China and real estate is overly discounted in terms of the bear case. But there are near term and longer term issues with iron ore that keep me kind of like I just don't see it rallying hard. The China headwind won't go away easily. The bigger issue that Volley is guiding now for more production, that it's like really it's like shale, right? You're gonna run harder now, when the market has stock lying around, and China, the optics around China are so negative. We're sort of in a window where the price is already down, so it's easy to say this, but I'm not thrilled at the prospect of iron ore. Like, I discount the prospect that it does incredibly well from here, but the company itself is in decent shape and earns decent money. But it does serve as kind of dead weight. And then the other issue with the banks, which are a huge percentage of these ETFs and the overall market, like Itaú and Bradesco, which have liquid ADRs as well, is that they're defensives, and they are the funding trades for when Brazil starts to work. So everybody's in them now.
Right.
And when Brazil rallies, they're going to be selling those to buy consumer discretionary and retail and stuff like that. There are also some utilities in Brazil, which, again, I don't love on their face if I'm playing an inflection with growth, because they're defensives, sort of like owning utilities in the US right now where everybody's overweight. But amazingly enough, even though everybody's kind of crowded in the utility space in Brazil, as local investors are, the valuations are so steeply discounted. You have, reasonably run utilities with real, equity IRRs of 12, 13, 14%. I mean, these are really cheap names. It's just, I don't see them rallying as much as, consumer names, industrial names, things like that. Gerdau, GGB, is a name that I've been taking a close look at. It's a major steel manufacturer, mostly long products. But in addition to being Brazil, they actually have a lot in the U.S. So there's kind of a silent kicker here where you're long the Brazilian zip code, but a huge amount of their business is in the U.S. steel sector, where if you get that growth to value, that large to mid cap, that, you know rotation that we've been discussing in terms of what may start to work in the coming months, Gerdau seems to be like X marks the spot because it's got the Brazil zip code and it's got the U.S. sector angle that I'm kind of more attracted to at the moment. So stuff like that. The payments names that I mentioned at the top, they've kind of run into trouble more recently because they're still dealing with a lot of the fallout from the bubble burst, and they kind of look like the Nasdaq in 2000 to 2002. You had like huge mountain stocks go to the 70s, 80s. Now they're at like 10. It's a long climb out of hell, so you have to kind of take a longer term view. But if you're going to be in a growth patch in the Brazilian value zip code, there are worse places to be. These names are pretty cheap. So stuff like that. Again, none of this being financial advice. I'm just saying, like, if somebody woke up tomorrow and said, what do I even start to look at for myself? Might be some ideas in some of these names.
That's perfect. Paulo, it was such a pleasure. I hope that you will come back on. And when you do come back on, I'll have to invite Rob to come on with us because he's the only other person I know that likes picks as much as you do and speaks English regularly. So you guys will have to nerd out about that.
Yeah, totally.
The views expressed in this commentary are subject to change based on market and other conditions. This podcast may contain certain statements that may be deemed forward-looking statements. Please note that any such statements are not guarantees of any future performance, and actual results or developments may differ materially from those projected. Any projections, market outlooks, or estimates are based upon certain assumptions and should not be construed as indicative of actual events that will occur. Cognitive Investments LLC is a registered investment advisor. Advisory services are only offered to clients or prospective clients where Cognitive and its representatives are properly licensed or exempt from licensure. For additional information, please visit our website at www.cognitive.investments. The information provided is for educational and informational purposes only and does not constitute investment advice, and it should not be relied on as such. It should not be considered a solicitation to buy or an offer to sell a security. It does not take into account any investor's particular investment objectives, strategies, tax status, or investment horizon. You should consult your attorney or tax advisor.